The next panel is focused on a very important topic that I'm sure is going to be dear to all of you. It's really where the money is going for funding in healthcare IT. And on that particular panel, I have a moderator, Ahmad, and DeGheest from Healthtech Capital, and Niko from General Catalyst Partners. And with that, I will leave you in their hands.
Thank you. Hi, everyone. My name is Ahmad Ejaz. I'm an audit partner at BDO USA LLP. We are the 5th largest global accounting firm. Do I need to speak loud?
Speak up a little.
Okay. And I serve the technology and life sciences industry. It's very relevant to our topic today, VCs investing in healthcare. We've got a panel of, we've got great panelists today. Anne, I would like to let Anne introduce herself.
Thank you. So I put 2 microphones. Can you hear me in the back? Hey, you see, this is entrepreneurship in Silicon Valley. We find a way around it. So my name is DeGheest. I'm a founder and managing director of Healthtech Capital, which is an ecosystem of angel investors, venture capital, and industry, really dedicated to how we use technology from your world, which is the computer and telecommunication mobile world, to change healthcare delivery with one endpoint, which is to decreasing cost. We also run the Healthtech conference in October because what we have discovered when companies come to us is that they really need to learn not to build a prototype, but to build a product and a business. And we can talk more about that later.
Niko?
Hi, everybody. I copied Anne's innovation. And,
typical VC, you know, copycats.
Yeah, VCs, exactly. VCs are cheap, so they follow, you know, the angels and the micro VCs. So I'm Niko Bonatsos. I'm a principal with General Catalyst Partners. We're an early stage VC firm with about $3 billion under management, and we invest in consumer and enterprise IT. In healthcare, we have invested in companies like Oscar, Imprivata, Dr. Chrono, and a bunch of other great companies.
Thank you. So Niko and Anne, 2013 was such a phenomenal year with respect to IPOs happening. The market was great. The same trend continues in Q1 of 2014. The IPO market has just gotten off to an extremely impressive start. There have been 64 IPOs so far in Q1, and the noteworthy thing is 30 of those IPOs are in the healthcare sector. And predominantly, out of those 30, it's the biotech industry that's getting a lot of attention in the marketplace. So I think that kind of dovetails into our topic, and I know you're involved with MedStars and Healthtech Capital. What is your primary focus with these 2 firms?
So I'm a mentor capitalist, which is, you know, company need more than money. They need a lot of mentoring, introduction to the right people. So MedStars is my own personal company there. I've been doing for 25 years, and I've been a black sheep. So yeah, for the last 30 years. So he wasn't returning my call, now he does. Where we really took technology. This is before he was born, sorry. And we really kind of have very disruptive technology, like some of people in healthcare, like Nellcore, Pyxis, VisiQ, which were really the granddaddy on changing healthcare delivery there. And then a lot of these companies, despite all these IPOs, are still having a problem getting the seed and the Series A. And this is where we start Healthtech Capital, which was an ecosystem to really help this company get off the ground. Now, I'd like to make one big point, and Niko is probably going to expand on that, is that healthcare is not the same across the continuum. So what typically happens is that in biotech, it was really, really hard to raise money for the early stage Series A and Series B of drug. It still is very, very hard. The only good thing is the last probably 12 months, there has been a few IPO on biotech that has kind of relieved the industry. On the medical device side, it is a nuclear winter. It is one of the hardest time ever in my life I've seen to raise venture capitals, and therefore the angels have disappeared also because it's very hard to do a bridge to nowhere. The hottest space is what we call digital health or health tech, which is extremely capital efficient. If anything, we can talk about this later. I think it's overheated. And that goes all the way from improving healthcare delivery for the providers or the payers, all the way to consumer and patient engagement. And so the IPO is only really happening, honestly, for biotech. And there has been one huge IPO in our space called Caslight. And it's just, how would I say this? It's going to be a case study in business school one day.
Niko, you're involved with General Catalyst Partners. Tell us something about your firm and what stage do you typically come in?
Yeah, so we invest in Series A, Series B stage companies, and we do a little bit of seed investing as well. The bread and butter is Series A stage. In the healthcare front, we're looking into investing in mostly healthcare IT. In the past, we did a little bit in medical devices, but as Anne mentioned, now it's a really, really hard time to be investing into medical devices for a suite of different reasons. In healthcare IT, there are 4 areas that we're very, very excited about. One is around chronic diseases, because 75% of all the dollars in the healthcare system are one way or another being spent on trying to treat or cure chronic diseases. The second area that we're really excited is about treating the healthy people. These are the ones that, because of Obamacare, they're getting a little bit screwed, and there are opportunities.
That's you guys.
Yeah, unfortunately, that's true. Like, young guys like me and a lot of the other people in the audience, we have to pay more and have a higher deductible. So there are a bunch of interesting startups that are trying to do stuff to help them pay less and also live a healthier life. Third area that we're very excited about investing is anything that basically tries to reduce the need for pen and paper and make the healthcare professionals seem smarter in front of their patients and their colleagues, save time, and make more money. Fourth area that I'm personally excited about is wearable devices that can capture really meaningful data, data that can demonstrate a reduction in the healthcare cost, like some of the devices that Daniel showed us before. And these wearable devices are not going to be the ones that are going to suffer from the iPhone in their legs and be part of the iPhone, but it's going to be devices that will be around for many, many years.
One of the things that we looked at is what's the user utilization risk? Will they use it? And in healthcare, who is going to pay for it? And that may not be the same person. And if you look at the spectrum in healthcare, you have providers where we spend $2.5 trillion per year. And those people, if you can go to them with a value proposition, we're going to deliver care that you are responsible for anywhere, not necessarily in the emergency room, they're not going at risk. And this is a major, major disruption of the industry right now because they don't really have the tools to take care of you anywhere you are. Will it be a chronic patient or healthy patients there? So the industry is being turned upside down right now. It's the biggest disruption of 18% of GDP, and it's creating opportunity, like Niko is saying, not only for the existing players, which is the providers and the payers, but also this is the market that is unproven, so it's a very hot market but it's unproven, which is would you be willing as consumer to pay and take charge of your health? And that's kind of the big play on wearables and the quantified self.
Thank you. So with such a robust activity in this industry, who do you think is the winner? Where is it going? And do you really think we are in the midst of a healthcare bubble right now?
I think it depends on the sector. I mean, clearly, if you're going to try to sell to hospitals, it is complicated. You have to understand FDA regulation, CMS reimbursement, which is changing very fast. And you have to understand clinical workflows. And you have very, 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 very long selling cycle. And I think I may have not enough long one on that one. So the good news on those is that if you can build a value proposition there, the barrier of entry is high, but therefore you can defend yourself, and you can build very big companies there. The activities where I think there is the bubble is where, ironically, there's the low barrier of entry. This is the direct to the consumer, where you think you have a low price point. The problem is nobody has really shown if you can build a market there that's sustainable. As you sure have shown, Nike has just dropped out of their armband. And so it is an interesting space where there's a lot of activities there. There's a very difficult but proven revenue models selling to the payers and the providers, and there's an unknown market, but large potentially, on the direct-to-consumer side. So I will not give name except the one I've invested in, which is Ahmad Ejaz and all those guys. But.
Yeah, so I'd like to add a little bit, to what Anne just said. Indeed, there is a lot of excitement for everything that is trying to do consumer health, and a lot of the teams that are getting into the space probably they don't have a very deep understanding of what's happening in healthcare, where the budgets are, who are the payers, and what are the business models that can work. But some of the teams, have demonstrated a unique ability to build a brand, tell a story, and have a lot of sales, either if it's devices or a lot of traction if it's downloads, in terms of users. When it comes to traditional healthcare IT or other medical devices, the barriers are much, much higher. But there are tons of opportunities that are being created either through Obamacare or the general need to curb a little bit the healthcare cost increase. And in fact, in 2013 was the first year after like many decades that healthcare costs went a little bit, down, didn't increase. So if you know where the budgets are, who are the payers, and what's the way to sell to them, there are unique opportunities to build products and services and sell to them. And I think a lot of smart investors continue to be excited because these are companies that can build massive businesses.
I call this follow the hot potato. Does anybody know what I mean by a hot potato? So historically, pretty much the people at risk were the employers. The US is the only country in the world where the healthcare cost being out of control was absorbed by the employers. Everywhere else is usually controlled by yourself or by the government. What has happened with the Obamacare is that the employer is saying we're out of that risk. What we're going to do is that we're going to drop it on somebody else. We're going to put you on a private exchange. We're going to give you vouchers, and it's a big name like IBM, Walgreens, and all of that. And depending how competitive the software market for employees are, we're going to give you more or less in that vouchers. But it pretty much means me as an employer am out of that risk category there. And they gave it to the providers. Well, the providers are realizing, oh my gosh, how do we do this? Because we don't even know our cost structure. How can you bid if you don't know your cost structure? Think about this for a second there. So there's all these companies emerging to try to help them figure this out. Now gets the big problem. You need to be big enough to do that. So what do? They're consolidating. So you have a massive consolidation of the hospitals buying physicians' practice. They want to reach $10 billion in size. When they reach $10 billion in size, they're going to be offering insurance tools. Guess what? They don't know how to do these tools. They don't know how to manage $10 billion of revenues in a structure and managing physicians there. So lots of opportunity there. Then they finally figured this out, well, this whole capitation and all this risk is really dangerous. We are going to dump it, guess who? On the patients. And this is where you see the high deductibles emerging at $6,000 if you are on the some of these public or private exchanges there. And so suddenly, guess what? When you buy a car, where you go on Consumer Reports, you test the car. You cannot do this in healthcare. Massive amount of companies coming out trying to provide that to you. So we are becoming what's called retail medicine instead of what was really wholesale medicine. And it's creating massive opportunity as you're moving that hot potato through the chain. So just keep that in mind. Follow where the risk and the money is.
Yeah, and quickly to add on this, because it's really a fantastic time to be thinking about what kind of services and products you can sell to self-insured employers to basically curb the costs over there. You don't really have to sell them nowadays on the ROI. In some instances, for example, in diabetes disease management, you actually start seeing a return pretty much, in the first month of usage of a specific product. And in certain categories of businesses like retailers that have tens of thousands, if not hundreds of thousands of employees and a very, very slim margin. And if they basically, have like 2-3% of their overall revenue spent on healthcare, you can demonstrate a dramatic increase in their profit margin if your services really work. So exciting time.
But there's something you have to be very, very careful as entrepreneurs. It is very unusual when you have a creation of a new market to have the large players coming in at the stage they're coming in healthcare right now. So you have all the big chains like Walgreens and Walmart who have figured out they own the retail space. 65% of Americans live within 3 miles of a pharmacy retail chain. They're going to go after the primary care provider business. They're already the biggest one for infusions, and they're going to basically say, we are going to managing when you're healthy, we're going to keep track of you when you start getting chronic diseases, and we're going to follow you with clinical, clinics and nursing at home. So you have people like Qualcomm and IBM discovering, hey, we're going to basically rationalize and decrease what's called the variability of care, which is if I'm sick and I see 3 doctors that give me 3 different diagnoses, that doesn't give you confidence. So all these opportunities are happening as entrepreneurs. Be very careful who the players are, who the big players are. They could buy you out, or they could squash you. So they're moving very fast.
So thank you, Anne and Niko. So there's so many aspiring entrepreneurs, I'm sure, in this audience. What is one piece of advice that you'll give to them in order for your firms to write them a check?
Okay, I guess I'll write the first check.
I don't mean to put you guys at spot. So.
So,
Take Hans' money first, and then follow on.
so yeah, he does a pay-to-play down on web me out, so, but we're friendly. I think it's very important that there is right now too many accelerators. I mean, there is like 15 digital health. I think somebody was telling me yesterday that there's 150 accelerators in Silicon Valley alone. The problem is that people are focusing on what they're good at, which is building a prototype. There's some echo here. And you come to us and he says, what's your pain point? What's your value proposition? How are you going to validate that? Who is going to pay? Is there a lot of those? Then you can show what the product is, and then you show me the team who can execute. And then we need to find out how much money you need coming behind us. Because if we think you're going to be very capital efficient, and you can basically go to cash flow positive with $4 to $5 million, that's a good value proposition. We get extremely worried when we know there's $50 to $100 million that have to come behind us, because that's the chance for us to be wiped out every time. Right now there is a Series B crunch. And so we are very concerned that we can't give enough runway so that you can basically get to a few $1 million in revenue, validate that there is a market. All this space are market risk and not product risk. So you need to spend your time on decreasing the market risk, not on improving your prototype. And because we're investing in businesses, we're not investing in products. We're also looking for missionaries, people who have a passion, we're willing to go at risk, do sweat equity, as opposed to mercenaries who just, are really there, not necessarily to build value and go for the whole ups and downs of starting a company there. So these are the things we're looking for. And what we have discovered is that getting a few $100K won't get you there. We need to do syndication with our angel group, even with some of our venture members, so that we can give you the $2 to $5 million, depending on which market you're playing, so that the big guys who come with big checks, say, okay, the team is working, they have executed, there are people buying the products, it's just a question of scaling it up. And that's the big change right now. Series B is scaling up, it's no longer proving the market.
In terms of what we're looking for visionaries who are learning animals, because a lot of the times when you go in trying to create a lot of change and build a massive business in a specific sector, you may not know everything about it, but over time, if you make the right decisions and learn every single day, you can become a domain expert 2-3 years later. That's critically important for us, especially when we invest in first-time founders. Secondly, in healthcare, especially if you want to build a business trying to sell to other hospitals or organizations, a B2B business, normally some prior experience is almost required because there are certain individuals that have the budgets or certain information flows that you have to be aware of. Often there are FDA processes that you have to go through. So prior experience helps a lot. Lastly, if you want to build a business in the consumer health, unique ability to tell your story, create a brand, and own the relationship with the consumer is something that is mandatory. Otherwise, a lot of capital will be required to acquire customers and do a lot of marketing. Some people tend to be better storytellers than others, and these are the ones that are building some of the companies that Daniel mentioned before.
Okay. So let's flip the coin now. From a founder's perspective, once they've gone past the angel stage, what kind of institutional investor syndicate should they be looking at?
Well, I think you're not looking for money. You're looking for smart money. I mean, you're looking for people who are going to basically help develop business partnerships, so they have the Rolodex to opening you up, a relationship that can basically scale you up faster. You're looking for people who can bring you the management team to fill up the rest of the team. I always tell people, when you start, you're one. Very quickly, you become 2 and 3. Build yourself an advisory board. And in healthcare, clinical advisory board, physicians are involved in this workflow somewhere, understanding how do they work, where are they going. Get yourself business mentors. They will open up the door to the right players for the Series B. You need, before you close the seed and Series A, you need to figure out what is your roadmap, who are the right partner for the Series B, and then talk to them when you don't need money. That's the best way to talk to them. Talk to them as soon as you close your Series A. Get your new investors to open the door. They're extremely credible. VCs invest in 0% of cold deals. All their deals are coming from somebody that they've worked with before, has been vetted by somebody they trust. So you really have to think your strategy there, about who is going to basically open those doors, and that's kind of the right people for the Series A will open the right door for the Series B.
To quickly add on that, I think you're looking for somebody who has conviction, and you want to essentially get married to a partner and build a business over the next 5 to 10 years. And unfortunately, unlike a marriage where there is a divorce, when you put somebody in your cap table, it's really hard, if not impossible, to kick him out of your cap table. So doing the dance, as Anne mentioned, from the very early days and talking to venture capitalists and see how they're thinking, and if you resonate with their thinking and you think that they can really open up their Rolodex and help you build a business over the next decade, is really, really critical. There are several institutional investors now that are investing in healthcare IT in particular, and a lot of us have done a bunch of content creation on the web or gave talks at conferences, so you a little bit know how investors are thinking and what they're interested in. So it's easier for you to basically approach them without having to waste a lot of time meeting 50 of them only to find out after the first meeting, so this firm has no interest in what I'm doing.
I think Niko is bringing a very good point. Do your homework. A lot of people are coming in this space who have never done it before. Will it be from the tech side or traditional biotech investors? It's a unique space. You need to be able to take market risk, be comfortable with the unknown, and then take a look at the portfolio company. Who have they invested with? If there's somebody that's a pure biotech person, ask them the hard question. How do you know how to sell to hospitals, CMIOs? And so really do your homework, interview them, and do a reference check of every CEO that this partner was on the board of. Think about that, you're interviewing them. This is, of course, after they've agreed they want to invest. Don't do it too early.
I think that's critical, yeah. VCs do diligence on who to basically invest in, but also entrepreneurs should be doing diligence on who to let sit on their board and have a piece of their cap table. It's very, very important. And all our founders, the ones that we've invested in, basically they talk to a lot of other portfolio founders that are either active in our portfolio now or even companies that didn't go so well. It's important to know how that individual that you're going to put on the board is thinking, how would she or he react in difficult situations? Because you don't want to find yourself, be very surprised when unfortunate things don't go as projected. And this happens. It's like, a 5-10 year long journey.
I think we have to be mindful of the time. So one last question that's very critical. What I'm seeing in the marketplace is there's a lot of biotech companies who are running very lean in terms of the employees they have. I mean, they have 10 to 12 employees and they're wanting to go public. A lot of their functions are outsourced. Do you think that's the new norm in the market?
Well, I think on the drug side, clearly these virtual companies, honestly, is the only way to make it happen. Honestly, for the getting phase 1, phase 2, people have now to go to billionaires, which are all over the world, to get this company funded because the traditional venture industry is missing in action. So you have to be extremely creative. I think that's what you're seeing that. Now the stock market is opening up recently there because there's been some very successful biotech IPO, which has opened up that opportunity for this company who literally are doing what are called not even angel anymore. These are kind of really billionaire investors there and go straight to partnership and then public. So it is an unusual situation right now, but as long as they've delivered, why not?
You agree, Niko? Okay.
Yeah, it's always a pendulum, right? There are hard times to raise money, and now it's one of the hardest, times. May, become, better over time, but high net worth individuals are a way to go, and also creating these virtual companies seems to be, the state of the union today.
Well, thank you very much. Those were great comments. I think we're off to a great start this year. It's projected to be one of the best years after the dot-com boom, so hopefully we stay on track.
Let's get rid of that word.
Thanks a lot.
Thanks.